Hey, this is Julian McClurkin, your chief storyteller with Tribevest. But today, we're not talking stories, we're learning lessons. This is a masterclass on how to build wealth. Today, I sit down with Jim Pfeiffer, the founder of Left Field Investing, to learn about passive investing through real estate. Next up in Chapter 7, we talk about how to choose a deal. Okay, Jim, so we've screened a sponsor, we selected an asset class, and we picked a few of our favorite markets. Now we're getting into deal flow. How do we choose the deal we want to invest in?
That's a great question. I'm a passive investor. I do not want to re-underwrite the deal. That's the job of the sponsor, right? So I've done a great deal of work evaluating the sponsor, getting to know, like, and trust the sponsor, and I understand that they know what they're doing, and I'm confident in them. So I don't want to do their job and dig into everything and figure everything out from scratch, right? Mm-hmm. That's their job. Now that I have confidence in them, I'm going to trust that the deal meets most of my metrics. So, but I still want to check. I still want to make sure. And the funny thing is, this is probably the shortest chapter, how to analyze the deal, because what you really want to do is make sure you have the right sponsor, mm-hmm. the right asset class, and the right market. Those are the tough parts. Now, when the deal comes, you look at it and you're like, okay, I knew this was coming. Mm-hmm. And so what we do at Left Field Investors, we created what we call a deal analyzer. And so we take maybe 30 different metrics and we put them in our deal analyzer, and it's an Excel spreadsheet that turns green if it fits mm-hmm. our parameters and red if it doesn't. And so red doesn't mean don't invest. Red means this generates a question. And how I use this is as another check on the sponsor. I'm checking the deal to make sure it fits my metrics, and we'll talk about a few of those. Mm-hmm. But I really am also checking the sponsor. So what happens is, let's say I get 5 red flags. So I'm going to contact the sponsor and say, hey, I got questions on these 5 things. Now, I'm not as concerned with what the answer is. I'm more concerned with how it's answered. Are you responsive? Do you get back to me within 24 hours? It sounds like that's a little too nitpicky, but if you don't get back to me before I've given you my money, are you going to get back to me after you have my money? Probably not. So that's a test. The other is, how do you answer my questions? Do you know the answers, or is it difficult for you, or do you get upset that I'm asking questions? All of those are red flags. Like, most sponsors are going to give me very detailed answers, mm-hmm. and that makes me not only feel better about the deal, but it also makes me feel better about the sponsor. So I focus on the metrics through the deal analyzer, and that's how I vet a deal.
Yeah, I like that. Well, let's bring up these metrics. What are some different metrics that you look at?
So, like I said, there's about 30 of them on that tool that we use, but everybody, I think, has their favorites. And some of the favorites that I have are rent growth, right? I want to see that and this is all looking at the Pro Forma. I want to see that they've had reasonable rent growth. I don't want to see 10% rent growth in year 1.
What's a Pro Forma?
Oh, thank you. So Pro Forma is kind of a prediction of how they think the financials will perform over the next 3, 5, 10 years, however long their time horizon is for that investment. So you're looking at, they do full financial reports based on assumptions that they make, mm-hmm. and that's the Pro Forma. So the rent growth Pro Forma, if they say they're going to get rent increases of 10% in year 1, I wonder how they do that. Yeah. Because most of the leases don't, they come due every, on all kinds of different dates. So how are you going to get everyone up 10% immediately? You're not. Mm-hmm. So a lot of syndicators will use, overly aggressive assumptions on rent growth. So, but if I see one that's 2 or 3% every year consistent rent growth, that makes sense, because you not only, and it depends also if they're a value add property, which means an old property where they're putting a bunch of work into it, you should be able to get more rent increase, right? Maybe you get 4% a year. If it's a property that was just built 3 years ago and there's no work to do to it, you might only get 1 or 2%. But those numbers have to be consistent. They have to make sense based on the property. Mm-hmm.
What are some other more important metrics?
So another one I like is break-even occupancy. So break-even occupancy is the amount of vacancy you can have and have the property still break even. Mm. So that just shows you how much buffer you have. And I like to see at least 80%, no higher than 80% break even, because if something goes wrong and occupancy drops to 90 or 85%, I know that we're still making money and we would break even at the 80% mark. So the lower that number, the better. Another one that I like that I didn't even understand before was economic vacancy. So it's not vacancy, it's economic vacancy. And when I owned single family properties, I always threw in 5% for vacancy, right? Just in my underwriting and evaluations.
Right.
Well, there's more to vacancy than just someone not being in an apartment, right? So economic vacancy includes vacancy, concessions, which is, you know, throw in a free month's rent or a TV if you sign now or something like that. Bad debt, which means uncollectible, you know, stuff you didn't collect. Loss to lease, which is the major one. So loss to lease is if the market rate for an apartment that like you have is $1,000 and you're only collecting $800, that's $200 of loss to lease.
Oh.
And so that's a real driver, right? If you have big loss to lease, you get rid of that, then your vacancy goes way down. And then there's actual vacancy, and then the last one is non-revenue units, like if they convert one unit to storage or something like that. So all of those add up to economic vacancy. And I like to see that economic vacancy at about 8%. If it's much lower than that, then that's one of the questions I ask. Why is economic vacancy so low? If it's below 5%, then I'm having a hard time believing it, unless it's in some place like Boise, Idaho, where someone told me there was like 3 vacant apartments in the whole town.
Yeah.
So those vacancy numbers I would believe, but you always have to put everything in context.
So economic vacancy includes that 5% of regular vacancy that you would typically budget for?
Yes, absolutely. Okay. It's all of those.
Okay, sweet.
Yeah. And so another metric I like to look at is property taxes. So usually when someone buys a property, the county reevaluates the taxes based on the new price that you bought it at, right? So taxes should be higher. And so what I look at in the Pro Forma, which is a prediction of what the tax burden will be, is I want to make sure that the current taxes are lower than what they're projecting in the future, because you're expecting the taxes to go up. So I just like to make sure, you know, that's another place where a syndicator could kind of fudge the numbers to make the returns look better, but in the end, they won't be better.
Is there anything else with regards to the metrics?
You know, I think everybody needs to find their 4 or 5 favorite metrics or what they really want to look at and concentrate on those. One of the things, and I mentioned this, but I think it's worth repeating, is that part of the process of evaluating the deal is the continuation of the evaluation of the sponsor. And so I really use the deal information, the deal metrics, to do a double check on the sponsor. Do they understand the deal? Do they know what they're doing? Are they going to communicate with me? And, you know, are they going to be responsive? I think those are super important things, because there's nothing more frustrating than sending someone $50,000 and not hearing from them again.
Oh, yeah. Yeah. Need a sponsor analyzer.
Yes.
Sweet. Well, that concludes Chapter 7. We're now headed to Chapter 8.